You've probably heard people say things like, "Buy the dip, the stock market crashed," or "I made money from stocks." But what actually is a stock? Why do stock prices go up and down every second? And how can regular people make money from them? In this video, I'll explain stocks in the simplest way possible, with real-world examples and zero confusing finance jargon. Imagine your friend starts a pizza business. At first, he owns 100% of it. But the business grows fast, and he needs money to open more locations. So instead of taking a huge loan, he divides the company into tiny pieces and sells them to investors. Those pieces are called stocks or shares. If you buy one share, you own a small part of the company. So if the company becomes more successful, your share usually becomes more valuable too. That's literally what stocks are, tiny ownership pieces of a business. Companies sell stocks to raise money. They can use that money to build new products, hire employees, expand globally, or grow faster. This process is called going public, or an IPO, initial public offering. Big companies like Apple, Tesla, and Amazon all have stocks people can buy. And once shares are public, anyone can trade them. Supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. But what makes people buy or sell? Usually things like company profits, news, new products, scandals, the economy, or even hype on social media. For example, if a company reports amazing profits, investors think, "Wow, this business is doing great." So more people rush to buy the stock, price goes up. But if the company loses money or bad news comes out, investors panic and start selling. Price drops. Sometimes emotions move the market just as much as logic. Fear and greed are huge parts of investing. How people make money. There are two main ways investors make money from stocks. 1. The stock price increases. Let's say you buy a stock for $50. Later it rises to $100. If you sell it, you made a $50 profit. Simple. 2. Dividends. Some companies share part of their profits with shareholders. These payments are called dividends, so just for owning the stock, you can get paid regularly. It's kind of like collecting rent from owning part of a business. Why stocks can be risky. Stocks can make people rich, but they can also lose people a lot of money. Because stock prices can change fast. A company can fail, the economy can crash, or investors can panic. That's why experienced investors usually diversify, invest long-term, and avoid emotional decisions. Historically, the stock market has grown over long periods of time, but short-term movements can be very unpredictable. How people buy stocks today. Today, buying stocks is easier than ever. People use brokerage apps to buy shares directly from their phones. You don't need to be rich anymore either. Many apps let you buy fractional shares, meaning you can invest with just a few dollars. But remember, easy access doesn't mean easy money. Investing still requires patience and learning. So to quickly recap, stocks are small ownership pieces of companies. Companies sell them to raise money. Prices move because of supply and demand. Investors make money from price increases and dividends, but stocks also come with risk. Once you understand those basics, the stock market becomes way less intimidating. If this video helped you finally understand stocks, hit the like button and subscribe for more simple finance explanations.